When you hear the word debt, what comes to mind? For many of us, it sounds like a problem. Credit card bills piling up, stressful loan repayments. We are often taught to stay away from debt as much as possible. But what if debt is not always bad? What if it's a powerful tool to build wealth, achieve dreams, and secure your future? This is the side of debt we rarely talk about. It's open to everyone, including you. Time to change perspective. Debt as a fundamental part of our economy. Think of debt as a formal promise. One person, the lender, gives money to another, the borrower. The borrower promises to pay it back over time, usually with extra called interest. This simple transaction is the engine powering much of our world. It helps businesses grow. It helps governments build roads. It helps governments build hospitals. It helps individuals buy a home. It helps individuals fund education. Without lending and borrowing, our financial lives would be very different. Understanding this is the first step to unlocking debt instruments' potential. In India, this debt world is vast and full of opportunities, not just for big corporations or experts. Products exist for every need and every person. Most cautious saver, ambitious investor. You can be a lender by putting money into these products, earning steady income from interest. This guide is your friendly companion. We'll demystify jargon and break complex ideas into manageable pieces. We'll show you how to make debt work for you, not against you. Leave behind fear and confusion around money. Forget the scary monster under the bed. Approach with curiosity and an open mind. We'll explore different debt products in India. Simple bank loans, government securities. By the end, you'll have the confidence and knowledge to navigate this landscape. You'll be equipped to make informed decisions for your financial goals. Let's begin. You might be thinking, this is all very interesting, but why should I, a regular person, care about debt instruments? The answer is simple. They are already part of your life. If you have a savings account, you are lending money to the bank. If you have a fixed deposit, you have bought a simple debt instrument. If you've taken an education loan, a home loan, or used a credit card, you've been a borrower. These are the building blocks of personal finance. Understanding them helps you manage money better. Knowing how debt instruments work is like having a superpower. It makes your money work harder. Some debt products offer better returns than a standard savings account, often with similar safety. They can provide a regular, predictable stream of income. That predictability helps with planning expenses or saving for a specific goal. In India, many seek stable, secure investment options. Learning alternatives builds a resilient, profitable portfolio, not solely tied to stock market swings. Understanding debt helps with big life decisions. Buying a house is a dream for millions, and it usually involves a home loan. Choosing the right loan and terms can save you lakhs. Starting a small business. You might need a business loan. Knowing what lenders want can mean getting funding, instead of your dream stalling. This knowledge lets you borrow smartly on the best terms. Learning the debt market also helps protect you. Finance can be confusing, and some people try to take advantage. Knowing risks and rewards reduces falling for misleading ads or making poor financial choices. You'll know the right questions and red flags to watch for. This guide gives clarity and confidence. It empowers you to control your financial destiny by truly understanding the tools at your disposal. Navigating the world of Indian finance can feel like entering a massive, bustling city without a map. There are countless streets and alleys. Some are well lit and safe, while others can be risky. This guide is designed to be your personal map. We will not just point you to the destinations. We will walk you through the routes, explain the landmarks, and warn you about any potential roadblocks ahead. Our goal is to make your journey through India's debt market a smooth and successful one. We will start with the basics and gradually build up your knowledge, ensuring you are never overwhelmed. In the sections that follow, we will act as your tour guide. First, we will visit the most familiar territory: bank loans. We will explore the different types, personal loans, home loans, and understand how they function. Then, we will venture into the world of bonds, debentures, which might sound complicated, but are actually quite straightforward once you learn the language. These are instruments that allow you to lend money to companies and even the government. We will break down exactly what they are, how they are different, and who they are suitable for, using simple, real-world examples. Our journey will then take us to a very important destination, government securities, or GSECs. These are considered some of the safest investments you can make, as they are backed by the Government of India itself. We will explain how you can invest in them and what kind of returns you can expect. We will also look at other corporate debt products, giving you a complete picture of the landscape. For each product, we will discuss the crucial details, the risks involved, the potential returns, and the type of investor who would benefit most from it. This will help you match the right product to your personal financial situation. Finally, no map is complete without a compass and a set of travel tips. Our final sections will focus on the practical side of things. We will provide you with a step-by-step framework for choosing the right debt product for your needs. We will arm you with a list of questions to ask before you invest or borrow, highlight common mistakes people make, and give you some essential tips to avoid them. By the end of our journey together, you will not just have a map. You will have the skills of an experienced navigator, ready to chart your own course in the world of finance. For most of us, our first real interaction with the world of debt happens at a bank. Banks are the most common and accessible source of loans for the average Indian. A bank loan is a straightforward agreement. The bank, as the lender, provides you with a lump sum of money, and you, the borrower, agree to pay it back over a set period. This repayment includes the original amount you borrowed, known as the principal, plus an additional charge called interest. This interest is the bank's fee for lending you the money and is how they make a profit. The process of getting a loan begins with an application. You approach a bank and tell them how much you need and why. The bank then assesses your ability to repay the loan. This is a crucial step called credit appraisal. They will look at your income, your existing financial commitments, your past repayment history, and your overall financial health. This helps them decide whether to approve your loan and, importantly, what interest rate to charge you. A person with a stable job and a good history of paying bills on time is seen as a lower risk and is likely to get a better interest rate than someone with an unstable income. Once the loan is approved, the bank disburses the money to you. The repayment journey then begins. Usually this is done through equated monthly installments, or EMIs. An EMI is a fixed amount you pay to the bank every month on a specific date. Each EMI payment is a combination of two parts. A portion goes towards paying back the principal amount, and the other portion covers the interest for that month. In the early years of a loan, a larger part of your EMI goes towards interest. As you continue to pay, more of the EMI starts to go towards reducing the principal amount. Understanding the basic mechanics of a bank loan is essential before you sign on the dotted line. It is not just about getting the money, it is about committing to a long-term financial obligation. You need to be clear about the total interest you will pay over the loan's entire duration, which is often called the loan tenure. You should also be aware of any extra charges, such as processing fees, prepayment penalties, or late payment fees. Being informed about these details helps you manage the loan effectively and prevents any unpleasant surprises down the road, ensuring your borrowing experience is a positive one. So, for a vast majority of Indians, buying a home is the most significant financial goal of their lives. It represents stability, security, fulfillment of a deeply held dream. A home loan is the special key that unlocks this dream. It's a long-term loan to buy or construct a house. Because the amount is large, home loans have the longest repayment tenures, often 20 years or 30 years. The key feature: home loans are secured loans. The property acts as collateral. The bank holds legal rights to the property until you repay the loan. If you default, the bank can sell the property to recover money. This security leads to lower interest rates compared to personal loans. Banks fund a big part of the property's value, but not all of it. That's the loan-to-value, or LTV, ratio. Banks typically fund up to 80% or sometimes 90%. The rest, usually 10% to 20%, is your down payment from savings. A larger down payment reduces the loan amount, which lowers your EMI and interest paid over time, saving you money. Life is full of events, both planned and unplanned, that require a significant amount of money. This is where personal loans come into the picture. A personal loan is an unsecured loan, its most defining characteristic. Unsecured means you don't have to provide any collateral or security. The bank lends you money based solely on your creditworthiness, income, employment stability, credit score. This flexibility makes personal loans incredibly versatile. For funding a wedding, for a vacation, for a medical emergency, or for consolidating other smaller debts. Because they're unsecured, personal loans are riskier for the bank. If the borrower defaults, the bank has no asset to sell to recover its money. To compensate for this higher risk, banks charge a much higher interest rate on personal loans compared to secured loans. The repayment tenure for personal loans is also much shorter, typically 1 to 5 years. This combination of high interest and short tenure means the EMIs can be quite high. So only consider a personal loan after careful thought and when you're confident you can manage repayments comfortably. Beyond personal loans, banks offer a variety of specialized loans. Car loans are secured loans where the car itself is the collateral. Education loans fund higher studies and often have a moratorium period. They begin repayment after completing the course and finding a job. This is a great help for students. It's crucial to choose the right type of loan for your specific requirement. Need money for an asset like a car? It's almost always better to take a car loan instead of a personal loan because the interest rate will be lower. Renovating your home? A home improvement loan, often an extension of your existing home loan, might be cheaper than a personal loan. Understanding these different loan products allows you to borrow more efficiently, saving you money on interest payments. Imagine you could act like a bank. Instead of borrowing money, you could lend it to a large, well-known company or even the government. In return for your money, they would promise to pay you a regular income, like clockwork, and then return your original amount after a few years. This is exactly what a bond is. It is a formal IOU, a certificate of debt issued by an entity that needs to raise money. The amount of money you lend is called the face value. The regular interest payment you receive is called the coupon, and the rate at which it is paid is the coupon rate. The date on which the issuer promises to return your original principal amount is called the maturity date. When we talk about bonds issued by private companies, you will often hear another word: debentures. A debenture is a specific type of long-term debt instrument. The key feature lies in how it is secured. Debentures can be either secured or unsecured. A secured debenture is backed by specific assets. This provides a safety net for investors. An unsecured debenture is backed only by the company's reputation, making it a riskier investment. You will also come across convertible and non-convertible debentures. Non-convertible debentures, or NCDs, are the most common type. Convertible debentures give the holder the option to convert them into equity shares. When you look for a place to put your hard-earned money, what is the first thing you seek? For most of us, it is safety. This is where government securities, or GSECs, shine. A GSEC is a debt instrument issued by the Government of India. They are backed by a sovereign guarantee. A government, with its power to collect taxes and print money, has the strongest ability to repay its debts. The risk of the Indian government defaulting is practically zero. This is why GSECs are often called risk-free instruments. There are two main categories: treasury bills or T-bills, short-term instruments, issued at a discount. The second category is government bonds or dated securities, long-term instruments. These bonds pay a fixed coupon or interest rate. The Reserve Bank of India, or RBI, has made it incredibly easy for regular retail investors to invest directly in GSECs. The most significant step is the RBI Retail Direct scheme. Using the RBI Retail Direct portal, you can buy government securities directly when they are first issued. This is known as the primary market. You can also buy and sell G-Secs, which is known as the secondary market. Another popular and simpler way to invest in G-Secs is through mutual funds. Specific debt mutual funds called gilt funds. It is managed by a professional fund manager, saving you the trouble of picking individual bonds. While G-Secs have no credit risk, they do have interest rate risk. If interest rates rise, existing lower coupon bond prices fall. If you hold to maturity, you keep coupon payments and get your principal back. Before you can choose the right debt product, you must first look inward. The journey begins by asking yourself 3 fundamental questions. First question: what is my financial goal? Short-term example: vacation in 6 months. Long-term example: child's education 15 years away. Second question: what is my risk tolerance? It's about how comfortable you are with losing money. Do you lose sleep over small dips, or can you tolerate volatility for higher returns? Third question: what is my time horizon? How long can you stay invested? Matching the tenure of the debt product to your time horizon is a critical rule. One of the biggest mistakes is chasing high yields without understanding the associated risk. The golden rule is to prioritize the safety of your principal. Ignoring the power of diversification is a classic mistake. By spreading your investments across different instruments, you protect your portfolio. Finally, a very common and costly mistake is not reading the loan agreement. Taking an hour or 2 to carefully read and understand every clause is an investment in your financial well-being. If there is one single message I want you to take away, it is this: debt is a tool. Like any powerful tool, it can be used to build wonderful things, or it can cause harm if handled carelessly. A home loan, used wisely, helps you build wealth. A business loan can turn an entrepreneur's vision into a thriving reality. These are all examples of debt being used as a constructive force. The trap is sprung when you borrow impulsively, for wants rather than needs. It is sprung when you get tempted by credit card offers and spend more than you earn. These are the mistakes that give debt its bad name. The secret to using this tool effectively is to always be in control. It means making conscious choices based on your goals and your risk appetite, not on market noise or speculative tips. Our guide has given you the map, the compass, and the essential travel tips. Now, the journey is truly yours to command. Your learning should not end here. Cultivate a habit of staying informed. Put this knowledge into action right now. Start small. You are the CEO of your financial life. Consultants help you decide. Financial confidence isn't having all the answers. It's knowing, asking the right questions, and make choices that let you sleep at night. Go forward. Make smart choices. Build the life you dream of. The power to unlock a secure, prosperous future is in your hands.